In this video, we're going to talk about Tesla, trading under the ticker symbol TSLA. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Tesla is an electric vehicle company manufacturing fully electric vehicles and also provides services related to energy storage and other renewable energy resources. It's a relatively diversified company with products servicing different sectors, with different segments of customers, each with their own needs and budgets. Tesla is often viewed as the flagship company of an entire sector, because its stock fluctuations may influence the rest of the sector as well, or even the tech stocks in general. Many portfolios that are future-oriented tend to be relatively heavy on Tesla, and we're going to talk about this later, because it is the undisputed leader in terms of sales, technical expertise, and established influence in the sector. Another appeal of Tesla is its CEO Elon Musk, who is one of the most recognized names in the industry and has a global following. The market cap of Tesla is currently at $903.8 billion, and the enterprise value is valued at $866 billion. The market cap is the price tag financial market is willing to evaluate Tesla stock at, with consideration to its future potentials and short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or the company may be under a lot of selling pressures. I think that in the case of Tesla, it is the later. The quick ratio of Tesla is 1.09, the current ratio is 1.39, and the debt over equity is 0.36. The average trading volume of Tesla has been 22.7 million shares, and the daily volume has been 18.8 million shares, 33.5 million shares, and 27.6 million shares recently. The one-year beta of Tesla is 2.61. Its 52-week high is $1,243.49, and its 52-week low is $539.49. Now, let's look at the options market for Tesla. In terms of volume and open interest, the options market seems to favor the call side. Usually, the put options mean that the market expects a pullback, and the calls options mean that the market expects the price to move up. The key strike prices where there seems to be the most interest are $900, $910, and $950. Tesla has recently managed to correct itself above $1,000 level once again, and that in itself, this is an excellent news for many shareholders of one of the most valuable corporations in the world. But I think that this optimism that we're seeing is partially due to subjective reasons or feelings. Many portfolios are very heavy on Tesla, especially the ones that are considered to be future-oriented. What pops to my mind would be investors like ARK, who saw a lot of their value getting picked up in the recent years by the appreciation of Tesla's equity value, and the subsequent selling pressure of their own units because Tesla itself is once again under a lot of selling pressure. So if we look at the stock performance of the past few months, Tesla's stock price has been on a clear downward trend, and this is mostly caused by the recent rejection of the infrastructure bill and evaluation of Tesla before this catalyst. I think that as far as future-oriented is concerned, we should be honest with ourselves and switch the word future-oriented to sometimes speculation-oriented. We are speculating about the amount of Tesla's potentials not being priced in yet, and the amount of shareholders who are looking to unwind their positions versus the ones who are willing to get in, and realize that some of their massive and yet diminishing gains accumulated over the past 18 to 24 months, maybe they want to cash it out. Personally, I believe that the upcoming releases are already priced in, but the new upcoming technologies are not. They may include complete automated driving, which I predict will mature and to be deployed within the next 3 to 5 years. This is a long time to wait, but I think that the patience is worth it. With that being said, a potential problem that is emerging is that Tesla may start to feel the weight and heat of operating overseas, and walking on the market shares of local competitors may not be an easy task. This is not something that can be considered a trend, but I would say that anecdotal events suggest that this possibility or this narrative is being prepared. So quality issues, potentially exorbitant costs, variances in cost-value ratios from one market to the other may be some of the pretexts to be used against Tesla. It is something that we should be aware of. This is why the price fluctuations between now and then is murky at best, and I can only provide a probable scenario based on my experience with trading stocks and commodities in the past. So, based on my experience, Tesla may go as low as $800, in my opinion, before the market begins to give it another go. This doesn't necessarily have anything to do with the company itself, but I do believe that a very significant portion of the market participants would prefer to see some recalibration of the momentum before reconsidering to enter the stock. It's actually quite simple. Those who have been holding Tesla for a long time would prefer to re-enter at a lower cost in the future. It doesn't mean that they no longer believe in the company, just that they believe that Tesla should see some of its gains being realized and let the market correct itself. My opinion on the magnitude of this correction may very likely differ with others' predictions, but this is only to help you structure your portfolios in such a way so that even if what I said happened, you wouldn't suffer significantly. My recommendation for Tesla is to keep a maximum exposure between 5 to 10%, and to keep at least 80% of your allocation for later, as the pullback doesn't seem to have ended just yet. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.